Hey, I'm Tommaso, and today I'm incredibly excited to share with you a conversation I had with Peter Walker, Head of Insights at Carta. Peter shares a lot of gold for all the startups and founders that are looking to raise money in this talk, so I cannot wait for you to dig in. You're listening to the Handbook podcast, where founders get practical advice on how to manage every department of their startup, from sales to marketing, product, customer support, and beyond. And now I'll leave the floor to Peter. So, Peter, thanks a lot for joining us. Excited to have you here.
Yeah, excited to be here. Thanks so much for having me.
Okay, perfect. So let's jump right into it. Um, I guess you see a lot of different rounds in size and type, and you talk to a lot of founders.
Yeah.
Which ones would you say are the key steps to a successful fundraising round? We can split it by round if you want. So maybe we can start from like pre-seed or seed. From the moment the founder realizes, okay, we need money, this is foundable, to actually closing the round.
Yeah.
What is the most common process you see from outreaching to VCs and angel investors?
So I actually wanted to jump back one point there because I think you said something really important. The first thing that we would suggest that founders do is just be really certain that VC money is what the path that you want to take. There are a lot of fantastic companies that have not raised any VC. But if you are going to raise money for venture capital, you need to understand that that comes along with important criteria and honestly demands from those VCs. So you will have to kind of do a deep dive into your business and understand, is this a VC business that I think I can grow to a really large outcome? Or is this a wonderful business that just might not be VC scale that I should try to fundraise in a different manner?
Do you have any guidelines to help answer that question? For example, I speak mostly to European startups, and what I came up with looking a bit of math for VCs is if you don't think your business can reasonably if things go well, but if things go well, you cannot reasonably say that you will be worth more than 300 million, which is really the bare minimum in Europe, then that's not a venture scale business. Do you have any other framework of looking at this?
There's a lot of different ways that you can look at whether or not your business is VC backable. You mentioned, I think, a really important one, which is can you get to a venture scale sort of outcome? Venture scale means different things in different markets. In the U.S., we might say that's half a billion or more in valuation would be a venture scale outcome. Um, you typically want to, if you're attacking or if you want to raise VC capital, you need to be working in a market that is pretty large. A target market, let's make up some ranges here, anywhere from like 25 billion to 100 billion to be a big player in that market would be a venture scale outcome. Um, the easiest one that we often see in the States is, do you have a pathway to $100 million in ARR? That's sort of the binary yes no. There are some businesses that raise VC that don't have a pathway to 100 million, but if you do, it's a good indication that your business might be venture backable. And if you can grow super quickly into that, that's all the better. But if you're working if you're working in a market where if the ideal conditions happen and your business succeeds wildly and that outcome is say 25 million in ARR, again, that's a fantastic business, but it's probably not a venture backable one. And you should ask, like, as you're going through this initial process, ask, if you know any VCs, if you know any angels, like, don't be shy. Ask them, like, is this a venture backable business? What would you need to see from this business in order to make an investment? Like, how does my market size impact your thinking? Because sometimes VCs are very strategic about that, and sometimes they want to bet on a founder that they really like, and that's what it is.
Yeah, makes sense. So, sorry, I sidetracked you a little bit there. Going back to the original question, then we realized that, okay, maybe we are a venture scale business. What would you say are the most effective ways of reaching out to VCs and even understanding who are the right VCs for us, right? Did you see any best practice there?
Finding the right VCs. So again, if we're just talking about the pre-seed stage, you may not even need to talk to real VCs for quite a while. If you have a network of people, maybe colleagues, friends, family, etc., angels who are operators at tech companies but are not themselves investors as their day job, you can actually raise a decent amount of capital from those people first. So the way that we typically see it happen on Carta is that a company will be an idea. Typically, that idea is brought on by one person, and then they are joined oftentimes by a co-founder or two. Although there are a lot of solo founders as well, that's totally fine. Um, and then you start working on that idea, and the first crux point that you're going to hit is: do I quit my day job and do this full time, or is this sort of a side project? Um, I will tell you that at least in the States, and I'm pretty sure this is true elsewhere as well, if you are not doing this as a full time job, VCs will almost never invest. They want to see your commitment before they're willing to commit dollars to you or any other currency. So that's something that you will be often asked if you're not quite out of your day job yet.
Yeah, I received
So
that
that's
ultimatum myself.
I'm sure. Yeah, it's one of the big sort of red lines. So that's one. Two, as you're going through this fundraising process, it's important to have not just raise money because either you have access to it or you think you're going to need it. The first thing to do is to sketch out a plan as to what you will do with specific amounts of capital. So, as an example, say you are an idea stage business, and what you need to do is you need to build an MVP of the product, and you also need to start selling to potential users, even if it's just a wait list because you've got nothing to sell them yet. Great. Those are two important goals. How much money do you need in order to make that a reality? Or to put it another way, what's the minimum amount of money that you need? Because the more that you raise, the more beholden to expectations you are. So it's actually at the beginning good to raise less money and see if you can move a lot more quickly with very little capital. And that shows a lot of progress for VCs later on. So that would be my first point of advice is don't raise to hit a specific number, raise to hit specific milestones. And then the number will sort of follow on.
I think that's a very common misconception with founders, right? Especially if maybe you are in accelerator, you see a lot of your cohort, let's say colleagues raising bigger amount of money, and you're like, okay, why shouldn't I raise that? My business is better than theirs, I can do more. But if you don't really need it, sometimes you find yourself with a messy cap table in a while.
Absolutely. Yeah. And then we can get into a little bit about how the cap table looks. That's Carta's bread and butter. We're an equity management platform first and foremost. So cap table, just for the founders out there, it just means who owns what percentage of your company. You can think of it as a Excel sheet that tells you, oh, this person owns X% of my company. And at the beginning, the cap table is probably just you and a co-founder. But as you bring more and more people on, advisors, investors, employees, everybody else associated with your business, that cap table can get pretty complex. So that's what Carta's software helps you through. And the nice part is that it's free. Carta is like all of our cap table features are free until you hit $1 million US raise. So it can be free for quite a while, especially helpful in this initial stage. One thing that you want to be aware of, one mistake that we sometimes see founders make is not valuing their equity highly enough. So what I mean by that is sometimes you will come to it's time to raise VC money, and VCs will look at your cap table and say, oh, you've already given out a lot of equity to a lot of different people. Maybe you gave a couple percent to an advisor, 5% to an angel, et cetera, et cetera. And that's not bad ethically. The problem for the VC is the VC thinks, okay, you're going to raise this seed round, and then probably you're going to need to raise 2, 3, 4 more rounds from venture investors in order to get to the outcome that we all want. Is there going to be enough of that pie left for each one of those investors moving forward? And if there isn't enough of that pie left over, it's very difficult for them to invest in your company because they just don't believe that you'll be able to raise after this fundraise. So be careful with giving out equity in your company. Carta exists to create more owners, so we want you to make sure that you're giving out equity to the people that are helping you, but you don't want to be giving out crazy amounts of equity, willy-nilly, and just kind of, give out equity to whoever asks for it.
Yeah, in a way, maybe this down market could help educate founders as well a little bit, because they're like, okay, I know that maybe in a few years or 2 years ago, I would have gotten a much better evaluation. So they don't feel as much this need of raising more money because they know that they're raising at a lower evaluation than what it used to be. And maybe that psychologically kind of helps, but definitely that's a mistake I've seen. And you have touched on 2 points. One about the angels that you can bring in during a pre-seed. So I'm a strong advocate when talking to founders of do experience first, meet cool people, meet people that you would like to have as co-founders and as investors. But sometimes it just doesn't happen. People maybe start very early, their startup, or they just don't have that type of network. Do, would you say there is any tactic that you've seen to find these like founders of successful startups that now are looking into investing money? Maybe they all rely on specific people that allocate their money through,
Mhm.
in different startups. Yeah, would you suggest anything to
Yeah,
someone that doesn't have the network?
it's a great point because I completely agree with the process that, there's this sort of old saying with founders and VCs, which is always be fundraising. Um, and that is actually kind of true and kind of untrue. The untrue part is you should not be spending every waking moment of every day trying to meet investors and get them to invest in your company. You've got a company to build. So there's a lot of stuff that isn't investor friendly. What I will say is always be networking. Always be putting yourself out there, meeting interesting people, especially if those people are A, deeply involved in the industry that you're building in, and B, have themselves built companies or been involved with early stage companies before. Those sorts of operators are wonderful people to add to your network. Some of them may become co founders, some of them may become angels, but all of them can be helpful as you sort of sharpen these ideas. If you don't have that sort of network, first and foremost, try to start building one. It can seem as though some people were just really lucky and were sort of born into this big network of people, and that can be true. A lot of times it just takes the work. Go to the events, reach out cold over LinkedIn to people, not because you want them to invest, but because you want to learn from them and be active and engaged in that process. So build that network is definitely a key one. Where do these operators sort of gather? If they're angels, if they've done angel investments before, they're typically going to talk about those either on Twitter, LinkedIn, other places. So you can kind of go through the social process and follow them there, start commenting on some of their posts, get to know them sort of socially through that social media relationship. Um, and then the other way is that oftentimes they will invest in a syndicate. So, you might find these syndicates on crowdfunding platforms, on all places across the web. But oftentimes there will be, some of the famous ones in the US are places like Air Angels, which is just a group of ex employees from Airbnb, Uber Angels, obviously former employees from Uber, et cetera, et cetera. And they all sort of invest oftentimes as a group. So getting an introduction to one of them can be very helpful. And I'm sure that there are similar platforms in Europe for sort of the European version of that as well.
Yeah, I really like the concept of syndicates because it allows you to reach a large number of people, and also it allow keeping things simple, but at the same time also getting maybe strategic investors in your company that are specifically interested in that sector. How does it usually look like the agreement with these angels in terms of equity, which I guess usually you would do like a safe, but what are maybe some mistakes you've seen in this area? Maybe people giving out board seats too early, or people giving out too much. So how does that? Yeah, what are the common mistakes you have seen?
Sure. So first and foremost, the SAFE, the simple agreement for future equity that was sort of pioneered by law firms here in the States and Y Combinator, that is the default instrument by which a lot of this fundraising happens, at least in the US. So what a SAFE is a very simple agreement. It's a one-page basic contract. And what it says is, I, the investor, am going to give you, the founder, X amount of money. And in return, whenever you raised your price round, so not right now, but whenever you raise priced equity from a VC in your seed round generally, I will then receive some equity alongside those other investors. So it is not, you're not giving up equity at the moment, you're giving up the promise of future equity when the price round is raised. So it can kind of feel like free money, but it definitely isn't. Um, so that comes along with two major criteria in every safe. One is a valuation cap, and two is a discount. So just take the valuation cap first. A typical safe in the US might be something like, I, the investor, am going to give you $100,000 on a, say, $5 million valuation cap. And all that means is when it's time to raise your priced equity round, uh, you'll look at what the valuation is at that moment. And if it's 5 million, then the safe investor gets one share for every share of the new investor's money. And if it's a 10 million valuation at the price equity round, then they get two because their cap was at 5 million. So it basically like sets the level at which their equity will convert once it's time for that price round. A discount does the same thing. It just says it's a little bit different. They say, hey, whatever the valuation is at your price equity round, take 20% off that, and that's the valuation that the safe investor gets.
Yeah.
So
Thank you.
it's good.
You're really amazing at explaining this. It's almost like it's your job. But
It's it's definitely it's not an. I came into startups at the beginning of my career, and I knew absolutely nothing about equity, and like it can be a really confusing space. So if you're going to take away anything from this, it's to ask a bunch of questions, go and try to educate yourself about equity. Carta has a ton of wonderful education resources on this that we can point you towards, but don't feel as though everyone else understands it and you're the odd one out. Like basically nobody understands it super well. Even at Carta, we ask questions about it, and this is our whole job. So don't ever worry that you're asking too many questions about equity. So you've got one of the biggest issues with a safe or a potential issue that we see founders make is they say, okay, great, I've got this idea of a safe investment. I'm going to go to my friends and family, and they're going to give me, as a typical example, say they give me $50,000 at a safe that converts at 1 million valuation cap. Cool. That $50,000 is useful. It gets me started. And then I might go to another set of angels, not necessarily friends, but just some angel operators that I know. And I get 100,000 from them, and the valuation cap is 5 million. And then I go to another set of pre-seed institutions and I get 200,000 from them, and the valuation cap is 10 million. It all seems pretty logical, but when the time for that priced equity round comes, you end up having given out more of your company than you're comfortable with. So that's a strategy called tranching, just like giving out a little bit for and raising the valuation cap as you go along because different people are taking different amounts of risk in your business. That's potentially fine as long as you're very clear about what that will mean for your equity, your founder ownership down the line. Because what you don't want to do is get to a seed round and realize I don't even own, I only own 30% of my company. I thought I was going to own 50%. Well, that's a big deal. And then those are awkward conversations to sort of like take back. So that's
you need
one
a platform
thing.
like Carta to keep track of all the.
Yeah, so that's that's a good advertisement for Carta there, because you do need to keep track of stuff like that. But even before you get to the platform part, there's a free calculator that we have at safes.carta.com, and I'm sure we can share the link, where you go to this, you give us your email, and then you have access to this calculator where you put in all the details of the safes that you're raising, and it spits out at the bottom for you like how much you'll own, how much your new investors will own, how much your safe holders will own, and you can just like drag your mouse across the screen and see, oh, at different levels, this is how that'll change. So that's a very, very useful tool, completely free, that can help you understand what a safe investment is going to mean. But as a broader point, if you're not familiar with safes or convertible notes, which is the instrument that a safe is sort of the evolution of, good to get those terms, good to get familiar with those terms and get them under your belt because it's probably how you're going to be raising money.
Yeah, makes sense. And we'll link all the sources and information that you mentioned in the description for sure for anyone that wants to give a look. I highly suggest it. And talking about asking questions about things we don't know very well, I recently encountered a concept after years, not as many as you, but years in the startup world, which is the one of like the fundraising advisor. Something that for some reason I just never came across. So when would you say is a figure like that necessary? What's the stage where that starts to become more relevant for a founder? It's like, okay, maybe I should get fundraising advisor for my series A, B. What would you say?
Probably not a series A. So the concept of a fundraising advisor is simply someone whose job it is to work with the founder very closely on the specific topic of fundraising only. So there's a lot of different kinds of advisors for startups. Some of them are industry advisors because they've got really in-depth knowledge. An example there might be a really well-known university professor who works in a biotech space that your biotech startup is working in, that kind of thing. There are financial advisors or advisors who function basically as strategic angels, and they maybe give a little bit of money into your startup, but their role in your startup is to introduce you to other people who have capital that maybe become investors. Those are very common. And then there's fundraising advisors whose job it is to, work with you for a set number of hours per week or something like that on your fundraise specifically and like all the ins and outs of that. They can be very helpful. If you are going to be a part of an accelerator or something like that, typically the accelerator themselves can fill some of that role. So you probably don't need to hire another fundraising advisor. And it's not as though you need a fundraising advisor in order to do this correctly. A lot of founders do this by themselves, and they'll make a bunch of mistakes, but they learn from that and they go along with this process. So it really comes down to your level of comfort as a founder. Are you going to be able to fundraise without this sort of advice? Or do you need a fundraising advisor to sort of walk you through this the first or second time?
Yeah. So you would say this is actually someone that comes along earlier in the earlier stages of the company, because then you would have someone in the team that takes care of that. Okay, interesting.
Yeah, that's my supposition. I mean, certainly you can find fundraise advisors that would work with Series A companies. I think the more sort of the meta point to make around that is um, a founder has two real jobs. One, the founder is responsible for convincing the right people to join the startup. So they are, first and foremost, they have to build the team, and that building is their primary function. The second function that a founder has is to make sure the startup does not run out of money. If you were to boil down the founder's jobs, to me, those are the two, by far the two biggest ones. Build the right team, make sure we don't run out of money. So if that second task, make sure that you don't run out of money, inherent in that is being a fundraiser. So it's not the kind of thing where you can have a fundraise advisor and that's fine. But at the end of the day, fundraising is the responsibility of the founder and no one else. So you have to kind of make that a part of your skill set, even if it isn't at the beginning.
Yeah, yeah. I don't know why I kind of envision this person as more later stages, because my take also is either, especially if you are like pre-seed or seed, as you said, you might be in an accelerator that helps you answer all these questions, or maybe you go to through this podcast and Carta's website and you educate yourself,
Right.
which you should do even if you have accelerators helping you. But then I guess a lot of your job should also be making your company so attractive that you don't need a fundraising advisor to really shove your product down the throat of VCs, especially in a moment like this one. But of course,
Totally.
that's maybe oversimplifying. Um, so let's imagine that the startup we discussed so far grew. We raised the pre-seed and we managed to raise also a seed round. What are
Yeah.
the mistakes that you see instead companies raising their Series A, and maybe also the way then maybe deploy the capital? Is there anything that you would suggest people should be
Yeah.
aware of when in that stage?
Sure. So yeah, you've raised a pre-seed, you've raised your first priced equity round as a seed round. You're a growing company. This is awesome. The way that the kinds of things that will happen at Series A that are not a part of seed or pre-seed oftentimes is by Series A, you're going to start to need to show growth on the revenue side and traction in order to really raise a significant Series A. So the kinds of metrics that you're evaluated on change as you move through the funding stages, pre-seed and even into seed somewhat. It's more about the team, the idea, the space, can you get your initial customers in the door? Can you start proving a little bit around product market fit? Once you get to Series A, product market fit is like going to be one of the biggest things you're evaluated on. And that is just the idea that there are paying customers who really want your product. And the way that you show that is by revenue. So having revenue into your business, in most cases, there are some industries where, if you're building in space, for instance, maybe you don't have that much revenue in the door at Series A. But for most industries, this is the time where you start showing revenue growth and traction and team growth as well. Some of the things that trip people up at a Series A, again, the cap table here can get much more complex. So you have these safe or convertible note investors. You've got the investors from your seed round. and you've probably at this point been introduced to some really significant venture capital terms that can come along with these deals. Things like liquidation preferences for investors, things like cumulative dividends. There's a lot of different ways that investors can write these contracts that you will have to either accept or decline, depending on how badly you want or need the money. And so having one piece of advice is having a great lawyer is very important here. You want someone who has your back and is looking out for your best interests and can negotiate with you alongside these VCs. Um, the other thing that you'll want to watch out for is, Series A is sort of, a lot of times, or a lot of things that have happened over the last 12 to 18 months in startups is that the focus from VCs has been on burn control and runway. So that just means how much capital do you have left before you run out of money? And again, that is one of the founder's primary jobs, making sure that's not the case. So one of the points of advice that we give founders, seed founders who have just raised a round is, this is great. Have specific milestones, what you're going to use that money for, and just know that you may be fundraising earlier than you might think. Again, you don't always have to be fundraising, but you should always be networking and keeping up with these venture capitalists in your ecosystem. One of the best ways, or one of the things we see really significant and successful founders do, is even if they're raising their seed round, they're already sort of talking to and in conversation with the people that might raise their Series A. And there's a lot of ways to do this. It can be as simple as, meeting them, introducing them to your company and saying, look, we're not looking for Series A capital right now, but I'd love to include you in our investor updates so you can follow along with the growth of the company. And then when the time comes to raise that Series A, you have an existing relationship with that investor already, and they're kind of familiar with how your growth has been going. And that's a really wonderful way to sort of think ahead to the next round while you're raising the seed. That applies to Series A, Series B, et cetera. Just always be looking one round ahead and making sure that those investors are getting to know you before you ever ask them for money.
Yeah, and I think a lot of founders are also scared sometimes of reaching out to VCs, and they definitely have very full inbox, but at the same time, we should always remind ourselves that their job is to find companies that bring them money and bring their LPs money. So at the end of the day, if you can interest them, you are doing them a favor reaching out, right? I think founders maybe should see it more that way sometimes and not be afraid to try and keep investors up to date. I think that's really what they value the most, at least in my experience. Seeing you're a founder, you are structured enough that every month you send me the numbers are trending up, hopefully. And if that's the case, it's going to make it so much easier for you to raise either from them or from other people they know in the industry, because that's also something I think important to remind ourselves, right? There is a network also inside the VC community.
It's totally true. They're going to share information about your startup, not NDA or proprietary information, but just like, hey, this founder seems to be a really quality founder. Here's how the traction is going, that kind of thing. Though that stuff will get out through the VC ecosystem. And then just to double down on the point, being the founder who is always reliable with their investor updates. It's on the first of every month. They always send it. It's not long, but even if things are going poorly, it gets sent, and they highlight things that went well, highlight things that need challenges, have specific asks. Like, that sets you apart from a lot of founders, to be honest. Just being able to communicate that reliably and that effectively to both current investors and then future investors, that's a really great look for any founder trying to fundraise now or in the future.
Definitely. How does a healthy board look like in a Series A, maybe even Series B company? Mm-hmm. Is there any red flag that you have when looking at it? Anything that founders should keep in mind? Because I guess a lead investor will often ask for a board seat, if not more. You might have other people also having one. So what's your take?
Yeah, so I'm certainly no expert on board composition. I think that there are probably other startup ecosystem people who would have great insight here. From a step removed, what I can see is that, yes, you're very right. Oftentimes the lead investor in each of these primary rounds will request a board seat. So the board composition tends to look something like the founder or founders plus the lead investors of the major primary rounds, plus one or two or three independent board members. And the composition of those independent board members is very interesting because it can sort of shift as the company needs shift. So perhaps there is an independent board member that you bring on when you're a Series A company that is, a found or used to be a founder in your space and is now just someone who you can go to for advice about what the next step of your evolution, what the next step of your growth looks like. There can be founders or there can be independent board members who bring prestige because they've served on a lot of different boards and they can sort of bring experience from all of those different companies to your company. But really, you want to be strategic about what am I going to gain from having this board member be a part of my company? Is it advice? Is it a network? Is it introductions to specific investors? You know, obviously the VCs on your board will know a lot of people in the VC industry and probably in startups at large. So they will be able to guide you oftentimes towards a great addition to the board. But you also want to maintain that independent network and just have people in your ecosystem that are fans of your company and want to help you grow. Um, you know, there are some you've heard stories about founders being a little bit worried about boards because, candidly, it's really the only way that a founder can be removed from their own company is if the board agrees and if that's there's just some disagreement between the founders and the investors in that stage. But at the very early stages, it's very, very unlikely that there's going to come to that sort of head really quickly. So you want to use boards sort of as a tool for growth and for the future prospects of your company, and there's a lot of ways to do that.
Yeah, definitely. We touched on also advisors. So maybe quickly, also in terms of advisors, what would you say is a standard way of bringing them on board in terms of like vesting and cliff? What type of agreements do you see more often?
Yeah, so if we're speaking now, let's jump back to the sort of pre-seed stage. Um, you have yet to raise any money from institutional VCs, but you're going to bring on an advisor to the business. And there, as we mentioned, there's a lot of different kinds of advisors. They can be people who uh, open up doors in terms of network for you. They can be people who help you grow the customer base of the startup. They can help you. They can advise you on technical details if they're a very specific technical advisor. Lots of different stuff. But typically, you're going to incentivize that advisor with equity, sometimes with cash and equity. But at the beginning, you probably don't have a lot of cash, so most likely equity. Uh, the median grant that we see for a pre-seed advisor in the US is something just under a quarter of 1%, so 0.25% or so. That's a very standard agreement. Typically, that equity will vest over 2 years, meaning they will have to earn that equity over 2 years of being associated with the company. And it's a 2 years. Sometimes there's a 1 year cliff. Sometimes it just starts vesting, every month or every quarter. It's kind of all over the
Yeah.
place on that.
Yeah, I think it makes sense.
Yeah, and I think that's also brings up a good point in general when you're talking about equity for a startup. Always, always, always have a vesting schedule of some kind applied to everyone's equity. This means advisors, of course, employees, of course, but also founders. Founders should have a vesting schedule applied to their equity. And that may seem counterintuitive because they're the founders. Without them, the company wouldn't exist. However, we do see cases in which you're part of a founding team, everything is going great, and then a year in, there's a disagreement between two founders, and one of the founders leaves. And when that happens, if there hadn't been a vesting schedule applied to that equity, they may leave with half the company, and then you don't have that person as a strong stakeholder in the company, but they still own a ton of the equity value of the business. So it's important for founders, just like everyone else, to have a vesting schedule. And sometimes it may be the case that you get into discussions with a venture capitalist and they say, we love your business. We would like to actually push your vesting schedule beyond where it currently sits. So you actually have to wait even longer to get the shares that you were promised because they want to keep you incentivized as the founder to grow the business alongside them. So vesting schedules are super important. you should always have one applied to everyone who owns equity in your business.
Yeah, it's very important to have some sort of prenup, even if you
Yes,
think you're
that's a
in
great way
love.
to think about it.
But yeah,
Yeah,
definitely, especially when there are potentially a lot of money involved, then it becomes even more important. And I think you
definitely.
you organically brought us to the last section of this interview, which is dedicated to the only people we didn't mention so far, but can be part of the cap table, which is employees.
Sure.
At least I think I didn't miss anything. So going to employees, how I saw, I think, from you an interesting graph of how the equity changes, the ESOP changes based on like employee number one, number two, number three, number five. So
Yep.
could you maybe tell us a little bit more about how that usually looks like? What should
Yep.
we offer the first employee that comes on board, and number five and number 10? Yeah, I'm
Yep.
curious about that because I think a lot of founders also struggle to understand when is too much, when is it too little, how can I incentivize them more?
It's a difficult conversation, or rather, it's a difficult negotiation to put clear parameters around. Because when you talk about the first 10 hires or so in a startup, those are the people that you're going to be building. Those are going to be the core, the foundation of the building of this business with you. Without them, probably the business will fail, or else you wouldn't be bringing them on. So they should be well compensated for their time and effort, and part of their compensation, because typically they can get a bigger pay package from a bigger tech company. The reason they're joining your startup is probably one, the mission, they believe in it, and two, oftentimes it's the upside of that equity. I want to be part of building this what could be a very big business. So what do we see for first five hire equity, at least in the States? The first hire at a startup, and we've taken away all founders. So anyone who's a founder, we're not considering in this analysis. And we've also said that if you own 5% or more of the company, we're going to consider you a founder, even if your title is not co-founder. And we're also going to remove you from this analysis. So leaving just those first hires, typically the median equity grant for a first hire is just under 1% on Carta, but the distribution is quite large. So about the 75th percentile is something like 2.5%. So you're talking about anywhere from 1% to 2.5% or so of equity for that first hire. And there's a lot of different variables that might push you one way or the other. If you, for instance, are a uh, founding team that is business focused and not technical, you don't do a lot of coding, you may need to overpay to get that first engineer in the door. And then the reverse is true. If you can code and build by yourselves, perhaps you would give a little bit less than the median to your first business hire. There's a lot of different ways to run these things. And again, this is not a perfect science. These are just parameters that you and your first employees can be having these conversations around. It decreases very quickly, actually. So the fifth hire, the median equity for the fifth hire on Carta is actually 0.18. So from 1% to about 0.2%. So it drops off real fast. And it kind of then sort of slopes down towards hire number 10, I think is about zero point 0.1. So again, less and less equity to people that join later and later in the startup's life. This makes some sense. Joining as the 25th hire at a startup is less risky than joining as the first hire at a startup. So that you're being paid in effect for the time risk of the money. And then, of course, basically after hire number, let's call it 8 to 10, it's more about the role and the seniority of the person than it is about the hire number. So if you're joining Carta now, we're a 2,000 person company. I'm not sure you'd even call us a startup anymore, but you're not going to be paid according to the 2,000th equity value.
Yeah.
You're going to be paid, oh, this is an engineer and they are coming in at director level, so we'll give them X amount of equity.
Yeah, and I would say that even if you're coming in as a higher up, unless you go really maybe like C level, but before you're probably not going to be that much further than that 0.2% you mentioned, right? If you're coming in as like 1,000th employee,
Totally.
that's not sustainable
Yes.
for the business to do much more than that. Yeah.
Actually, businesses, so to your point, businesses set aside a certain portion of their equity for employees. It's usually called in the States an employee stock option plan or an ESOP. And that grows a little bit as the business grows, but typically speaking, the early stage companies are going to have an option pool of about 13 to 15% of the shares of their company. And then as they go through funding rounds, they might add some more shares to that pool to keep hiring new employees. So it gets to be about 20% or so if you are a unicorn.
Yeah, perfect. And as a last question, there is a bit of a obscure topic for a lot of founders, which is secondary rounds, which connects to ESOP as well. So how how would you suggest founders manage secondary rounds? Do you think it's something that most startups past a certain point should consider? Should they give often the option to their employees to maybe sell part of their shares, and to their founders, I guess, as well?
Yeah, so secondary liquidity is a business that Carta has been in for a few years now. I think it's a really interesting part of the startup ecosystem. What it refers to explicitly is the idea that employees or early investors or even the founders themselves occasionally would be able to sell a part of their private stock before the company IPOs. So it's still a private company, but you're exchanging shares on what's called a secondary market. Um, we saw a trend in the boom time of 2021 and early 2022 of companies giving their employees access to these sorts of secondary markets more in a more structured fashion and more often. That's kind of receded a little bit in 2023, but there are still a lot of companies who are thinking about how to make sure that employees can take some of the value of their equity off the table a little bit more easily. And this sort of folds into the discussion of private versus public companies in general. The big change in this discussion is that private companies are staying private a lot longer than they used to. So I think if you just take, for instance, Airbnb as an example, they were a private company for something like 11 years before they IPO'd. So that's 11 years where the equity in this case was not actual cash for those employees. It was just numbers in their cap table software. And that's tough, having the promise of a startup equity. That's part of the reason why you joined, is to, have the upside. But if you can't access that upside because it's all just in, it's not IPO'd yet, then you're losing a lot of time value of money there. So I
Employee number
personally
one
love
at
the idea
Stripe
of
would be very frustrated.
everyone at Stripe was pretty frustrated. I think if you read some of those headlines recently, they had to do a secondary transaction just
Yeah.
to like make sure that the employee base was okay, because some of those people had been there for a dozen years, and
Yeah.
not realized a dime out of their equity, and that's really tough. So I think secondary liquidity is going to become more and more of a thing in private markets. This isn't the same thing as going into your Charles Schwab account and selling a share of Amazon. Like, it's a much more complicated process. But I do think that the trend will be towards giving employees some way to realize some value out of that equity before an IPO.
All right, perfect. Peter, I want to be mindful of your time, so I'll let you go. Thank you for this interview. It was really, really insightful. I'm sure that a lot of founders will benefit from this, make less mistakes. We'll link all the resources you mentioned during this call in the description for anyone that wants to read further, for anyone that wants to try Carta. We also have a deal with Rapido where you can get a little bit of a discount on a premium plan if you were to raise more than a million in funds.
Yep.
Is there anything that you'd like to say to close this off? Maybe any call to action that you have for people to follow you or to.
Sure. I mean, you can find me on LinkedIn if you just type in Peter Walker and Carta. I'm sure I'll come up. And I post, data-driven insights about startups 3 or 4 times a week nowadays. But yeah, thanks so much for having me. This was fun and hopefully useful for all your listeners.
For sure, for sure. Thank you, Peter.